Big tech is about to spend more money on AI than most countries spend on entire industries. We're talking about hundreds of billions of dollars pouring into data centers, chips, infrastructure, and everything needed to power the next wave of artificial intelligence. On paper, it looks unstoppable. The numbers are massive, the demand is rising, and every major company is racing to build faster, bigger, and more powerful systems. But hidden inside this boom is a problem that doesn't get talked about nearly enough. Because when an industry starts scaling this aggressively, the biggest risk isn't always competition. Sometimes it's the things you can't fully control. Right now, the AI race feels like a classic tech expansion story. Companies are investing heavily, building out infrastructure, hiring talent, and pushing new products into the market. The assumption behind all of this is simple. Demand for AI will keep growing, and the companies that invest the most today will dominate tomorrow. That logic has worked before. It worked with cloud computing, it worked with smartphones, it worked with social media. So naturally, big tech is following the same playbook again. Spend early, scale fast, and secure your position before the market fully matures. But AI is not just another software trend. It is far more dependent on physical infrastructure than most people realize. Behind every AI model, there are massive data centers filled with specialized chips, cooling systems, networking equipment, and constant power consumption. These are not lightweight digital systems that can scale instantly. They are heavy, expensive, energy-intensive operations that rely on global supply chains and stable economic conditions. And that is where the weakness starts to appear. Because the entire AI expansion depends on a few key inputs staying relatively stable. Energy has to remain available and affordable, hardware supply chains have to keep moving smoothly, global trade has to remain predictable, and geopolitical tensions have to stay manageable. If any of these factors start to shift, even slightly, the cost and speed of building AI infrastructure can change very quickly. And when you are dealing with investments on the scale of hundreds of billions of dollars, even small disruptions can have large consequences. Take energy, for example. AI infrastructure runs on electricity, and a lot of it. As companies build more data centers and push more compute into the system, their dependence on stable power grows. If energy prices rise sharply, or if access to power becomes constrained, the cost of running these systems increases immediately. That doesn't just affect operating expenses, it changes the economics of the entire investment. Suddenly, the return on those massive infrastructure projects starts to look less certain. At the same time, building new power infrastructure is not something that happens quickly. It takes time, planning, and regulatory approval. So even if companies are willing to spend more to secure energy, they cannot always get it when they need it. That creates a bottleneck. And bottlenecks are dangerous when the entire strategy depends on scaling as fast as possible. Then there is the supply chain side of the equation. AI systems rely heavily on advanced chips, and those chips come from a relatively concentrated set of manufacturers and regions. If there are disruptions in that supply chain, whether from trade restrictions, political tensions, or logistical issues, the impact can ripple through the entire industry. Delays in hardware delivery mean delays in data center deployment, and delays in deployment means slower growth. Geopolitics adds another layer of uncertainty. The AI race is not just a business competition, it is increasingly tied to national interests, technological leadership, and economic influence. Governments are paying attention, policies are shifting, trade rules are evolving, and that creates an environment where long-term planning becomes more difficult. Companies are making investments that are meant to last for years, but the global environment around those investments can change much faster. All of this creates a situation where the AI boom looks incredibly strong on the surface, but underneath it depends on a delicate balance. As long as energy remains accessible, supply chains remain stable, and geopolitical risks stay contained, the growth story continues. But if that balance starts to break, even slightly, the impact can be felt across the entire system. This is where the idea of a hidden weakness becomes important, because the weakness is not in the technology itself. The models are improving, the products are getting better, the demand is real. The weakness is in the foundation that supports all of it, and that foundation is not entirely under the control of the companies making the investments. What makes this even more interesting is how expectations are built around these investments. When companies commit hundreds of billions of dollars to infrastructure, they're not just planning for current demand, they're betting on future demand. They're assuming that usage will grow, that revenue will follow, and that the systems they build today will continue to deliver value. But if costs rise or expansion slows, those assumptions can be challenged.
And once expectations start to shift, the narrative around the industry can change very quickly. What once looked like aggressive growth can start to look like overextension. What once looked like strategic investment can start to look like risk. And in markets driven by confidence, those perception shifts matter. There is also a timing problem here. AI development is moving quickly. Companies feel pressure to build now, to secure capacity now, and to stay ahead of competitors now. But infrastructure investments play out over much longer timelines. You commit capital today, but the full benefits may not appear for years. That gap between short-term competition and long-term infrastructure creates another layer of tension. So, companies are caught in a difficult position. If they slow down, they risk falling behind in one of the most important technological shifts in decades. But if they move too aggressively, they risk building systems that depend on conditions they cannot fully control. And at this scale, those risks are not small, they are systemic. This is why the AI boom feels different from previous tech waves. It's not just about software, platforms, or user growth. It's about energy, supply chains, global politics, and physical infrastructure. It's about systems that are interconnected in ways that are harder to manage and harder to predict. And that brings us back to the core issue. The $635 billion AI bet is not just a story about ambition. It's a story about dependency. Dependency on energy markets, on global stability, on supply chains, and on long-term economic conditions. As long as those dependencies hold, the growth continues. But if they start to shift, even slightly, the impact will not be isolated. It will spread across the entire ecosystem. In the end, the biggest weakness in this massive AI investment wave is not something you can see in a product demo or a model benchmark. It is something much more fundamental. It is the fact that even the most advanced digital systems still rely on very real, very physical, and sometimes very unpredictable foundations. And those foundations do not always scale as smoothly as the technology built on top of them.